Treasury yields dipping, again, slightly ahead of that. Let's bring in Kathy Jones of Schwab. Kathy, it's good to have you on the program. You know, it's one thing for the Federal Reserve to say something. It's another thing for the bond market to do something. And the Fed can say what it wants. In Europe, they've been cutting rates, and borrowing costs have gone up, not down. What do you expect to happen on Wednesday and going forward?
Yeah, Brian, I think the key is not so much the Fed cutting, because that's pretty well discounted in the market. The key is really what happens with inflation going forward. So it's a tough situation when you have the Fed cutting rates because the job market is slowing down, while inflation is, stubbornly sticking around 3% and edging higher. That's not a great dynamic for the bond market because it suggests a certain kind of stagflationary environment. And it also means for investors, well, do you want to get extra yield for going longer term maturities to compensate for the risk that the Fed's making a mistake and allowing inflation to pick up by easing when inflation's moving the wrong direction? So really tough situation here, but I think the major issue that's going to drive bond yields over the next 6 to 12 months is going to be what happens with inflation rather than what happens with the Fed.
Because, a lot of Schwab's clients, maybe they want to buy a home. And they're like, well, the Fed's going to cut rates, so mortgage rates will go down. Let's wait it out. It's not a guarantee, Kathy, is it, that the Fed cuts and mortgage rates go down? I mean, they could stay the same or move higher.
Yeah, and we've seen that. The Fed has cut rates, and we've seen the yield curve steepen. That is, yields, as you move out, are not coming down at the pace that short-term rates are coming down, because they're driven by not just what the Fed does, although that's a component of it, but also inflation expectations, what the expectations are for growth, and just supply and demand. How much are investors willing to invest in, say, 10-year bonds or 20 or 30-year bonds? And right now, around the globe, you're seeing some hesitancy in the longer-term bonds because countries are running big fiscal deficits, inflation is going the wrong direction, and there's not a lot of confidence to move out the yield curve. We also have the Fed reducing some of its holdings of longer-term bonds. So a big issue for the market is, can private investors come in and buy these bonds with this dynamic going on? I would say we'll get some rally in the bond market after the Fed cuts rates, which we expect. I'm not sure it's going to be enough to get those mortgage rates back below 6%.
And you either read my mind or read my notes, Kathy, because I was going to ask you about QE and QT, quantitative easing, quantitative tightening. It's boring, call it WBI, wonky, but important because what the Fed does with its balance sheets is pretty doggone important, right? Maybe more so in some ways than the benchmark lending rate. Do you think there's any chance that the Fed comes back in if it needs to meaningfully drive down borrowing costs?
I don't think at this juncture the Fed's likely to do that. They've been trying to reduce some of their holdings to get back to a Treasury-only balance sheet. I think one of the interesting questions will be, depending on who is the new chair of the Fed, there's been a lot of talk about having the Fed's balance sheet maturities match with the Treasury's issuance. Fed Governor Waller has talked about this, maturity matching. And what that could mean, if that happens longer term, since the Treasury's been issuing a lot of T-bills, that the Fed would actually be buying less of the long-term bonds. And that would probably cause those yields to either climb or not to come down. So I think it's going to be an interesting and volatile period for longer term bonds, waiting to see how policy evolves.